The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A 7-week rally in benchmark equities gets a reality check from a 6-day sell-off in benchmark treasuries. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Isabel Lee. We're kicking you off through the closing bell today on this Monday, and this is where we stand. We're looking at an S&P that wiped out all of its gains at around 10:30 a.m. in New York, on track for its second down day, down by 0.8%. We're seeing investor jitters really rise over that imminent deal between the U.S. and Iran, and this is probably why you're seeing Brent crude up by nearly 3%. We have Bank of America from Cisco Blanche saying that the best case outcome would roughly be around a $90 per barrel Brent crude for the rest of the year. But the big story here is the bond market. We're seeing a little bit more moves that are subdued compared to the global rout that we saw last Friday. But still, we're seeing highs we've never seen for a while. You have a 10-year yield that's at 4.6. That's the highest in roughly 1 year. 30-year yield at around 5.1, the highest in over 3 years. So Romaine, Fed Chair Kevin Warsh, who is yet to be sworn in, hasn't even seated yet, and yet he's already facing a huge test.
Yeah, and as we count you down to the closing bells of U.S. equities, I think we want to pick up where Isabel left off with the focus on debt markets. The yield on 30-year U.S. bonds, the highest in 19 years. Japan's benchmark yield, the highest in 27. U.K. yields, the highest in 28. It's a pointed message coming from the bond market that the U.S.-Iran war, the AI spending splurge, the fiscal imprudence by developed economies worldwide, for some, becoming a bit too much to bear.
It does feel like the bond vigilantes are back. And so I wouldn't say that we're losing the anchor, but I would say that global term premium is back in focus. And that's exactly right.
And that might be a bit of an understatement. The additional compensation investors are demanding to invest in 10-year treasuries instead of 2 years. That jumped significantly last week, particularly on Friday. And the worry is that bond markets could tack on an even higher term premium, given the upward inflation pressures and the belief that the Fed might just be too late to adjust its policy. And therein lies the risk for equities. While tech stocks are still cheap based on expectations for future earnings, a bond market turning more volatile and long-term interest rates creeping ever so higher, well, that's kind of upending the calculus. Mike Wilson and his team over at Morgan Stanley still maintaining their bullish call for the S&P to rally to 8,300 over the next 12 months. But they do highlight how the bond market ructions could be the fly in the ointment that upends this breathtaking but narrow 3.5-year bull market. So we kick you off to the close here on this Monday afternoon with a read on, well, what investors are actually seeing, particularly in the retail space. Stephanie Gill joins us right now here in Studio 2, CIO at Robinhood Markets. Stephanie, great to see you.
Thank you. Great to see you, too.
So I do wonder, I mean, we've been wringing our hands a lot about elevation in oil prices, elevation in interest rates, elevation in inflation overall. But when you look at the retail set, I am curious as to whether they're as rattled by this as some of the folks on the institutional side.
Not that we've seen. We've definitely seen continued net buying. And as recently as the last week, the biggest buys were still in the more semiconductor space and the memory space, Micron and Intel. So we haven't really seen a big change. The one thing that I have been seeing actually in the prediction market side is that there have been more and more trades of predicting the price of Bitcoin on a particular day, which actually might be the right environment, like a higher inflationary environment might be the time for Bitcoin. And also predicting the price of gas at the pump and oil at the pump as well, which is exactly the way I would imagine using prediction markets as sort of like a hedge to your everyday life.
Yeah, I think we're all trying to predict what the price at the pump is going to be, but maybe for different reasons. I am curious, though, about the tech side of this trade. I mean, this has been a relatively narrow rally, still kind of focused on the AI boom and all the CapEx money sort of fueling that. We're going to get NVIDIA earnings in about 48 hours or so. I am curious as to how much life you think is in that trade. And I don't mean like the long-term structure. Yeah. We know AI is going to be a big thing longer term. But when you look at valuations for some of these names, have they gotten too far ahead of themselves? Or do you think that maybe people are pricing in this appropriately?
From a technical perspective, yes, select names I think have gotten too high. I have been looking at kind of a combination of moving average, a number of different terms and metrics. And some of them are showing me that they are extreme, almost at an exhaustion level. And so I do think it's healthy to have somewhat of a pullback. And you're actually seeing that in those names today. Names like Marvell, Coherent, like the names that really were very strong. Do I think it will be like this forever? No, because I just think demand is extremely high and there's only so much you can make. There are physical limits to the physical part of AI, and we have to deal with that.
So earnings have been strong across AI. 90% of the S&P 500 companies have reported there are more beats than misses. Why are you neutral on some of the high-flying tech names?
Simply because of the technicals and that, I think a lot of that is already priced in. The one thing I am also a little bit worried about, I haven't done anything about it in terms of names or positioning, but is there a probability that in advance of knowing that you couldn't get stuff in the future, like if there's a lot of demand for things and prices are going higher, does some of that demand get pulled forward such that the earnings won't be as strong in the future because they've already done all the ordering they can do and there's only so much that can be made in a year? So that's something I'm watching closely, but I do think it's just a matter of expectations.
How do you square a market where oil prices are where they are, yields are at multi-year highs, and we have Morgan Stanley, to Romaine's point earlier, even upgrading their S&P price target? I mean, one has to be mispricing something, one would think.
Maybe in the short term versus the long term, I think maybe it's like a time thing. Earnings is the thing that the bulls can certainly hang their hat on, right? Like you just said before. So I think that's not necessarily going away, but I think there does come a time where you have to recognize that we're heading into probably a little bit of a rotation where power and energy starts to come through a little more. And that's why I think in a portfolio, having some energy and some commodities is extremely important in an environment like this.
I do just want to bring to the attention of our viewers right now, as we're in conversation with Stephanie Guild over at Robinhood Markets, we are getting a redhead across the Bloomberg terminal that the President of the United States has said that he is calling off a planned strike on Iran that, according to him, was scheduled for tomorrow. He specifically says he has told Pete Hegseth, the defense secretary, to be prepared for a future Iran attack. But for now, he has instructed Hegseth as well as Kayne to hold off on that. You are seeing a sharp spike in S&P futures right now and a slight spike down in oil prices, though they are still in the green on the day. And Stephanie, I want to bring you back into the conversation because this has kind of been the story now. The headline risk sort of driving this market back and forth over the last few days and weeks. And I do wonder if that is sort of our future, that this type of volatility where we're getting these swings is kind of the new normal, or at least the new normal that investors are prepped for.
Yeah, I think so. I think about a year ago, I started talking about vol, the VVIX, and that being elevated and higher. And that, I think, is likely to stay because you're going to have periods of calmness and then periods of not, especially with just lots of different endeavors that the country is trying to take on. And I do think we were actually in a period where inflation was starting to get higher and just this conflict has just exacerbated what was already going to happen because, as I said, the physical demand for things is going to create lots of swings. And this is an environment that most people who are in the market have never seen, right? If you think about the last time we had supply constraints like this, it was in the 70s. So there, I think
But are you surprised by the resiliency that we've seen, not just in markets, but I mean, we just came out of this corporate earnings season, and the numbers, at least by objective measures, were relatively nice.
I'm not surprised by the resiliency right now. I do think that it takes I think there's still a lot of cash on the sidelines. I think there's a lot of capital out there, but I think you're starting to see that wane. And obviously you've got the K-shaped economy aspect, right? Like those in the markets can continue to invest in the markets and those not in the markets are definitely being impacted by this. And that's also being exacerbated.
All right, Stephanie, great to have you here on the program. Stephanie Guild, CIO over at Robinhood Markets, kicking us off to the close here on this Monday afternoon. We focus on equities, and we're going to stay on top of the moves in the bond market and what it's signaling when it comes to the U.S. and the global economy. A conversation up ahead with Fabio Natalucci, the CEO of the Andersen Institute for Finance and Economics.
Then we'll broaden it out to the global perspective with the G7 finance ministers meeting in Paris today. A conversation with Tim Adams, president and CEO of the Institute of International Finance.
And we're going to talk AI and talk that big lawsuit. We got a jury verdict, and we're going to talk about what it means in Elon Musk's legal battle against OpenAI. All that and more coming up in a bit, right here on The Close. This is Bloomberg. All right, we want to talk about the Fed a little bit here because the White House is said to be holding a swearing-in ceremony for Federal Reserve Chair Kevin Warsh this Friday. Now, ahead of the last Fed meeting, the Andersen Institute for Finance and Economics wrote a piece titled "Fed Communication Needs to Embrace the Full Range of Risk Out There," with the Institute calling on the FOMC to update its language for a world that is about to see more inflation. We want to bring in the CEO of that institute, Fabio Natalucci. He previously held roles at the IMF, the U.S. Treasury, and the Federal Reserve Board. Fabio, great to have you here. I do want to start off with this idea of communication in the context of some of these more, I guess, persistent pressures that we've seen rise up over the last couple of years, whether it's the persistence of inflation or, more importantly, the persistence of the volatility that we've seen with regards to price levels. And I am curious as to exactly what your thesis is on how the Fed, if at all, can even take that into account in a better way.
So thank you, first of all, for having me. I think the narrative we had in mind was one where there are a number of structural forces that are changing essentially how to think about inflation. One of it is this increased fragmentation. So with the globalization going away, we start seeing more fragmented global economy and financial markets, and those come with costs, with inflationary pressure. We see in AI that, at least in the short term, could put upward pressure on inflation. And then we have a series of supply shocks. We started with COVID, then we have the Russian invasion of Ukraine, we have tariffs, and now we have yet another shock with the conflict in the Middle East. So our story is that some of this pressure are going to be here to stay. Right? We'll see markets are going to have to essentially start pricing in a number of risk premia into asset classes, reshaping the supply chain or defense expenditure. There's going to be a number of things that are going to put, at least in the short to medium term, upward pressure to inflation. And then the macro backdrop has also changed. Right? Back a few months ago, we were thinking about inflation was coming down. There was a cooling of the labor market. And so easing in that environment made sense because you did not want to have real rates going up, so effectively tightening policy. Now we are the inverse of the world where inflation is coming up. Rates are essentially the policy rate and it's not moving. So de facto what you're doing, you get real rates are actually easing. So you have a stealth easing at a time when the last inflation print plus the structural forces I was just describing are going to put, at least for a while, upward pressure on inflation.
I am curious with regards to the current situation with regards to energy. I am curious. I mean, you were at the IMF and wrote the Global Stability Report at a time when we had the Russian invasion of Ukraine, which, of course, created an oil shock. You were back there at the Federal Reserve during the onset of the global financial crisis. Does what we're seeing now have any parallels or hallmarks to what we saw back then?
I think the Russian invasion of Ukraine is the closest you can get in terms of the supply shock. My concern is now that this is the fourth shock in a row in terms of supply. And so what firms or what consumers actually have learned when they form their expectation about where prices are headed, what kind of negotiation there will be in terms of wages. So the risk is like where this inflation expectation may become more entrenched. Now, there is little signs over the medium term, like whether you look at what it's in the TIPS market, inflation swaps, or even surveys, but there are some uptick in measure, for example, like surveys 1 year or 2 year ahead, and also in the market-based measure inflation expectation. Right? The 5-year TIPS since the beginning of the war is up 20, 30 basis points. So 5 years TIPS it's not something I would call the short term. So that's, for me, that's a sign that you should be concerned about.
Inflation has been above target for around 5 years now. At what point does temporary become structural?
This is exactly the point, that you have these structural changes that are occurring under the hood, plus you have this inflationary pressure that are continuing to occur, this supply shock that happens. And the biggest concern, I think, that they get embedded in inflation expectation. That's why we were calling in that op-ed to have a more symmetric description of the inflation outlook. Under what scenarios the appropriate policies to keep the rates where they are, under what scenarios the committee will be willing and thinking about easing monetary policy, but under what scenario, in fact, there may be a need to actually increase interest rate so that you don't have this de facto easing of real rates against a backdrop where financial conditions are extremely easing. Right? Ultimately, the transmission of monetary policies from short-term rates to financial conditions. And I think I would struggle to characterize financial conditions as tightening at this point.
And you've also said that globalization as we know it is effectively dead. What do you think replaces it? And could that be more inflationary?
What is replacing globalization as we knew until a few years ago, it's a world where there is more fragmentation along fault line of geopolitical alliances, for example. So more fragmented trade, more fragmented financial market. And those comes with costs, come with inflationary pressure. Right? I can mention a few supply chains that need to be redesigned, not based on efficiency, but based on the needs to address some resiliency issues. You can think of defense spending. You can think of like onshoring. And I think part of this is what we see in the long end of the curve globally, where 30-year rates are north of 5% in the US, 5.7% in the UK, north of 4% in Japan. Some of it probably has to do with inflation uncertainty. Some of it has to do also concern about the fiscal outlook, how much spending will have to be put in place, and how much of this will generate inflationary pressure that would require, in a world where inflation is higher than what we knew before COVID, would require rates to be higher as well.
Fabio, really appreciate it. Really smart stuff here. Fabio Natalucci, now the CEO of the Andersen Institute after a very long career over at the U.S. Treasury, the U.S. Fed, and the IMF. Now, when we come back, several big name and small name retailers are set to report earnings later this week. We're going to talk about those expectations in the market when we come back after the break. This is The Close on Bloomberg. Time now for our top calls. We'll look at some of the big movers on the back of analyst recommendations. First up, we want to take a look at CoreWeave, the neo-cloud company that rents GPUs to those needing computer capacity, getting an upgrade. D.A. Davis analyst Gil Luria assuming coverage with a neutral rating and a $100 price target. Luria saying he's skeptical of CoreWeave's ability to generate sufficient returns given its margin profile and dependence on debt financing. Those shares taking a little bit of a leg down here for a second straight day. Next up, let's take a look at Constellation Brands. Citi opening a positive 90-day catalyst watch on the beverage company, alcoholic beverage company. The analysts expecting an acceleration in beer top-line trends into the summer with the start of the World Cup soccer tournament and its popularity within the Hispanic community that the analyst says can boost that company's deep portfolio of Mexican beer brands. Those shares up for a third straight day. And finally, let's take a look at Deckers. Piper Sandler upping their recommendation to neutral from underweight and raising the price target to 100 ahead of results that are due out a little bit later in the week. The analysts expecting a fourth quarter beat and guidance for the next fiscal year that brackets that consensus. Those shares getting a modest bid on the day, up about 1.3%, back to their levels from late last week. And Isabel, there's a lot been going on here when we talk about the health of the consumer and the health of the economy here against the backdrop of some of these earnings we're going to get. We're going to get some big ones like out of Walmart, Home Depot, Lowe's, and of course some kind of second tier ones as well, but also just as important, including Deckers and TJX.
I'm curious to know what investors are looking out for. Is it NVIDIA more or Walmart? Because as we know, Walmart, it's a bellwether of the economy, but NVIDIA, where NVIDIA goes, the market goes, and 90% of the market has already reported, and there are more beats than misses.
Absolutely, and this gets to the idea here, and it's a good point here. We talk about this K-shaped economy, but it's also a K-shaped market, a market that has been driven over the last few weeks and quite frankly, the last 3.5 years largely by that big CapEx spend going on in the AI space. And there's been a lot of drama going on in that space as well. Elon Musk, we learned just about an hour ago, lost that high-profile court case against Sam Altman over OpenAI's future. Our next guest, though, says that this is actually a big win for Altman, and it now lets OpenAI focus on what a lot of investors are looking for, and that's an IPO. Dan Ives joins us right now, the global head of tech research over at Wedbush Securities. And Dan, this is what everybody was talking about here, how much of a distraction this case was going to be, particularly if Elon Musk had come out the victor. At least for right now, it looks like Sam Altman is the victor, and I assume that paves the way for this IPO to somehow get out the door sometime this year.
Yeah, this was a bit of a black cloud, right? It was what could happen with the lawsuit in terms of, if Musk ultimately wins. And look, it's a positive for OpenAI. It's a positive for Altman. Yeah, and look, relative to Musk and SpaceX, I think investors would almost say they'd almost rather him focus on SpaceX as well. And this is an arms race. No one's throwing sand in the gears right now of OpenAI.
How does this affect xAI, especially as Musk tries to position xAI as the rival of OpenAI?
Yeah, look, they're behind, right? I mean, it's clear. Now, look, you combine it with SpaceX. We think ultimately you combine it with Tesla, next year. But you have Anthropic top of the mountain. You have OpenAI. It was viewed that this was going to slow them up. it's not, right? So now the question is that it's about CapEx. It's about just trying to narrow the gap. It's no different than what Google's done as well, but it's not going to be through the legal, right? It's not going to be through lawsuits. This is more of a soap opera that ultimately has, a pretty positive ending, at least for OpenAI.
I am curious, too, and there's been a lot of soap operas going on in the AI space. From the perspective of Microsoft, because there are a lot of people focused on that as well. Obviously, they came up a lot, and of course, Sundar Pichai had to testify with regards to sort of what happened behind the scenes. But do you get the sense here that Microsoft is still committed to holding on to its OpenAI stake and riding whatever wave we get over the next few years?
Yeah, I do think. I mean, look, if you go back, that was high drama, and if it's not for Nadella, I don't even know, what the situation would be with OpenAI. He needed to almost be the sort of adult in the room at that time.
Yeah.
But they are committed, but also it's training wheels as well. I mean, like Microsoft's doing a lot of their own organic initiatives. It's part of what they need to do in terms of Azure, get Copilot, obviously, further up in the game to where they need to do. And look, but this is, from Microsoft, I continue to think they're in a very, very good position. But OpenAI, it's obviously a partner, but a competitor as well.
Yeah, and I did misspeak there. I meant Satya Nadella, not Sundar Pichai.
Very quickly, Dan, what do you think this reveals about the economics of AI, especially with tens and billions of dollars tied to these companies?
Game of high stakes poker, right? And I think this just shows that, the amount of drama that's going to go on internally. This is just the start, right? Get the popcorn out. This is not going to be the only lawsuit, and we're going to continue to see this play out across big tech. It's going after $4 trillion to spend next 3 to 4 years. When that happens, you're going to have a lot of sort of sharp elbows going after it.
Dan, always appreciate you jumping on for us. Dan Ives here over at Wedbush Securities. And just to recap here, we did learn just a while ago that a jury had rejected Elon Musk's claims against OpenAI that Sam Altman had somehow betrayed the original mission of that company. Of course, the key issue here right now for investors is whether this paves the way now for OpenAI to continue ahead with its plans to go public. Now, when we come back, we're going to take a relook now at what we've been seeing in global bond markets, a relook at the global world of finance and geopolitics, a discussion up ahead with Tim Adams, the president and CEO of the Institute of International Finance. That conversation coming up next, right here on The Close, right here on Bloomberg.
And I think this is probably, in a way, the signal that the bond market is telling us. Guys, make sure that you react without going too far down the budgetary line, because we know it's a supply side shock. You cannot deal with a supply side shock by subsidizing demand. That doesn't work.
The French finance minister there is talking on the sidelines of that G7 meeting in Paris, discussing the bond market and the global economy. It is 3:30 p.m. here in New York City, and this is the countdown to the close. I'm Romaine Bostick.
And I'm Isabel Lee.
And, it's kind of interesting. I think they came in there with an agenda that was going to be a little bit more focused on something else. But right now, all the talk right now is about, I guess, fiscal imprudence, if you will, over the last few years, and whether that's finally caught up with some of these developed nations now that we're starting to see, I guess, what is another inflationary shock.
Definitely, and I can imagine, I would love to be a fly on the wall on their meeting last Friday. They must have really overhauled their agenda, and we see the global bond markets really sending borrowing costs higher at a time when, to your point, there's massive concerns on fiscal deficits, AI disruptions, and energy supply disruptions. And you have incoming Fed Chair, I should say, Kevin Warsh, who's long criticized the Fed for keeping rates longer for too long, affecting inflation. Well, that's exactly what he's inheriting right now.
You're taking a look at those yields there. The change on the day may not necessarily look all that spectacular, but if you could look back as to where most of those yields were just about 2 to 3 months ago here, it puts into perspective here some of the concerns in global bond markets. Joining us right now is Tim Adams. He's president and CEO of the Institute of International Finance and spent a few years here and there over at the U.S. Treasury. Tim, great to have you here. I do want to start off with the debt situation. There's been a lot of talk, and of course that was the talk at the G7. And I think in your own latest global debt monitor, you talked about, I just want to make sure I get this number right, $353 trillion in the first quarter in global debt. That's up more than $4 trillion in a single quarter. Yet you have stock markets not far off record highs. Global economies overall still growing at relatively healthy paces. Is there a reason to worry right now about these debt levels?
Oh, absolutely. The run-up in debt levels globally and certainly among advanced economies, about 115% of GDP for the advanced economies. And, you know, the U.S., we're running deficits of over 5%, and we're soon going from 100% to 125% by 2035. The numbers are pretty harrowing. They throw in the U.K., France, Japan. And given the huge geostrategic challenges that we're facing, or build out in defense spending, for example, trillions to be spent on artificial intelligence, and so many other huge investments against the backdrop of an aging population and really challenging demographics.
I am curious, though. I mean, when we talk about how prepared our financial markets are for any sort of big shock, I mean, I'm talking like something really dramatic along the lines of what we saw during past crises. I mean, you are kind of tapped in with what all the banks are doing, what they're saying, how they're feeling. Is there a sense of preparedness right now out there?
Well, there's certainly the leadership. The C-suites are certainly building in expectations of potential disruptive outcomes. And look, we still have a conflict in the Gulf that doesn't appear to be resolved anytime soon. We still have a conflict in Europe's eastern periphery. We're now in the 5th year of that conflict. We have huge supply side and supply chain shocks, but the markets tend to shrug it off until they don't. And at some point they won't. We'll realize that, you know, there are real factors and there are real constraints on the economy, including the fiscal trajectory of many of these economies, that just isn't sustainable over the medium and long term.
You've had a lot of eye-popping numbers in your note, which we really appreciate. One is China's economy now nearly 80% of the size of the U.S. in real terms. How should investors be thinking about that big shift in global power?
Well, it's been going on for many years. I've been going to China since the mid-1990s and seeing this economy really evolve. And look, they're a powerhouse in manufacturing, whether it's in electric vehicles or robotics. In fact, most of the global industrial robotics are installed in China. They are a huge and important manufacturing behemoth that I don't think the rest of the world fully understands the role that capacity is going to play vis-a-vis other manufacturing platforms, including in Europe.
You've also said that the decoupling between the U.S. and China is real. At this point, do you think it's reversible or not?
Well, we have seen a drop-off in trade. Now, some of that's being redirected through other third countries, whether it's Thailand or Mexico. And I think the administration, the president, certainly focused on whether there are backdoors in the U.S. So it's being redirected, but it most certainly is dropping. But I think the president's trip from last week, he's looking to increase exports in key items. And I think we'll continue importing certain goods. I think it's difficult to fully delink, but it certainly has evolved over time.
With regards to sort of, I guess, where markets go overall, and I'm talking global markets, Tim, there's been a lot of talk about a lot more money flowing to non-U.S. Markets, particularly in emerging markets and maybe to some extent some of the developed markets in Europe. Is this shift that we've started to see, do you get a sense that that might be temporary, something cyclical, or is that the start of something a little bit more long-term and structural?
Yeah, I think it's long-term and structural. Everyone's looking to rewire, and trade flows are being rewired. I think they're looking to new markets to sell into, new markets to source out of. We're seeing efforts to build in resiliency and redundancy. That's costly, given that we optimize the global economy for efficiency for many decades. So it really is about building in new sources, new suppliers, new markets, new allies. The world is rewiring itself, absolutely.
And that sort of poses a challenge, I think, too, for Kevin Warsh. And we were speaking a little bit earlier with Fabio Natalucci, and we're talking about Warsh, who's going to be sworn in, I believe, later this week. Is there a sense that we do need to start to rethink the approach to monetary policy, particularly when it comes to fighting inflation, if some of these structural shifts are indeed structural?
Yeah, well, I'd say this. Kevin's a good friend of mine. We were colleagues many years ago. I've known him a long time. He's a very capable leader, very thoughtful, and I think he's very nimble on his feet. He certainly fully understands the trends that are in place, and I think if he needs to have a different perspective, he most certainly will. The question is, how much of this pickup in prices do you look through, and how much do you think is permanent? Frankly, I think a lot of it is really shifted, just given the supply shock that we see in place and this need to shift supplies and just items that we never thought about before, whether it's helium or whether it's diesel or whether it's fertilizer. I think this is a real serious structural shift, and it'll really challenge Kevin as he starts out in his new tenure.
We have around 30 seconds here, Tim. You know that this isn't 2008 or 2020, but that margin of error is kind of shrinking slowly. What worries you the most right now?
Well, we're priced to perfection, right? And I talk to market participants all around the world, and they're very, very bullish. But What I see when I read the headlines or I travel and talk to policymakers or those in the geostrategic area, I have a lot to worry about. Again, we still have conflicts in the Gulf that isn't even near being resolved. And until that is, we still have a lot to worry about. And I think markets need to better appreciate what those true risks are. And they're enormous.
Tim, really appreciate you taking time for us. Tim Adams, he's the president and CEO of the Institute of International Finance, here as we keep an eye on the broader equity market, still in the red for the benchmark S&P and a little bit deeper for the NASDAQ, though we should point out the NASDAQ is off the lows of the day, and that is critical here as everyone focuses in on the AI trade and specifically some earnings out of NVIDIA that are set to come across the wire in just about 48 hours. Ed Ludlow actually had a chance to catch up with the CEO of NVIDIA, Jensen Huang. We're going to hear from him on what Jensen had to say when we come back after the break. This is The Close on Bloomberg.
The Chinese government has to decide how much of their local market do they want to protect and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open.
That's NVIDIA CEO Jensen Huang alongside Dell CEO Michael Dell earlier today at Dell Technologies World. They talked about several issues affecting AI space, from China to the AI build-out, in an interview with Bloomberg Tech co-host Ed Ludlow. He joins us live from Las Vegas. Now, Ed, thank you so much for joining us. That conversation made several headlines, but I want to talk about AI chips because Jensen Huang said he expects Chinese authorities to eventually allow the import of AI chips from the U.S.
Yeah, so what he was talking about there was this balance, right, that China wants to protect its domestic players, largely Huawei. And so in deciding whether or not to allow Chinese technology companies to buy NVIDIA chips, that's the trade-off. The demand for compute is great there, just as it is all over the world. But they also are conscious of the American technology stack filling that gap. Beyond the comments that you just played, probably the biggest piece of news from the interview is that Jensen Huang himself did not have any sort of direct conversation with Chinese officials. He was very clear that this was President Trump and those relevant cabinet members that were with him speaking with their Chinese counterparts. And we're still kind of reconciling this idea that even as recently as March, NVIDIA talked about the idea they were ramping up their supply chain to send chips to China, the H200, because the US had granted them licenses. Well, they have earnings on Wednesday, and either sales to China show up as a line item or they don't. But you would infer from that they won't, based on the idea that it's all waiting on China to send some approval, whether they do or don't.
And another thing that came up, and I've been curious about too, is this idea sort of what we've been seeing in the memory space and sort of what we can glean from that with regards to the broader AI build out. Did Jensen, or for that matter, Michael Dell, did they have any sort of comments about where we stand in that cycle? And I do mean cycle.
Yeah, cycle, and it's still tight. Right, the point I made to them is that historically memory is cyclical and it's boom and bust. And the point that both Jensen Huang and Michael Dell made is that they have tried to give this entire market as much of a heads up as possible. 3 years ago, they both explained how they met with the key memory CEOs, the CEO of Micron, CEO of SK Hynix, saying you need to have more permanency and capacity. And now the main takeaway, particularly from Michael Dell, is that he sees those memory names putting their money where their mouth is. They're willing to invest in that capacity, some of which happening on the East Coast, right? With Micron, we do see it being built because the staying power of memory demand, specifically from the data center, is completely different to the smartphone market or the PC market that we've seen having a cyclical nature in the past.
Unpack for us, Ed, around 30 seconds here, what Jensen Huang meant when he said we need to make sure supply chain is prepared and it will be hard to keep up with an AI build-out for the next decade.
Yeah, I was really surprised by his comment that he sees the supply chain for everything that goes into a supercomputer server doubling or quadrupling on an annual basis, and that's still not being enough. So it gives some indication of the severity of how demand is still outpacing supply, which for many, that's a very good position to be in, but it causes frustrations, why we're so zeroed in on CapEx.
Ed, always appreciate a great interview today. Bloomberg Tech co-host Ed Ludlow out there had a sit down a little bit earlier in the day with Jensen Huang and Michael Dell. And just a reminder, we will have full and special coverage of NVIDIA's earnings, which come Wednesday after the closing bell here in the U.S. Meanwhile, we count you down to the closing bells here on this Monday afternoon. Joining us to break down not only today's market action, but what to expect in the days, weeks, and months ahead, Biel, portfolio manager and senior research analyst over at Kayne, Andersen, Rudnick. That's coming up next, right here on The Close, right here on Bloomberg. Just about 10 minutes until we get to the closing bell. Romaine Bostick here with Isabel Lee here on this Monday afternoon. And Isabel, it's been another volatile day, both in equity markets and in bond markets.
We're seeing S&P on track for its second straight day of losses, but that didn't stop us from clinching a seventh straight week of gains. Last Friday, I think that's the longest stretch since 2023. Who knows what the market will bring? We have NVIDIA earnings on Wednesday, but still, I mean, we have Morgan Stanley saying equities are at risk of a significant pullback with a global market sell-off, global bond market sell-off, but still, at the same time, they raised their 12-month price target for the benchmark to around 8,300 last week. So it's really just a confusing market, Romaine, and you're seeing, again, a bond sell-off. We're seeing multi-year highs we haven't seen in a while, especially for the 10-year and the 30-year.
Yeah, and of course, that bond sell-off could end up being the bugaboo here in what has still been a phenomenal rally in equities over the last 3.5 years. An equity market that, while down on the day, still not far off its most recent record highs. Biel joins us right now, portfolio manager and senior research analyst over at Kayne, Andersen, Rudnick. And Julie, I do want to start with this idea of whether it is too early or maybe for some people a little bit too late to start worrying about some of these signals that have been coming out of the bond market with regards to rates and inflation.
I mean, I'm French, so it's never too early to be worried, right? I'm always worried. That's a lifestyle choice for me. I do think it is really important to pay attention to what's happening in the bond market. There's a different perspective in that market that prevents it from some of the euphoria that some of us equity investors are guilty of. And I think we really do need to recognize that the market right now is so structured towards an AI future that is still many years away. And when we have higher interest rates, that really changes a lot of the dynamics of how we can value those future projects. Can we still support these large CapEx projects if interest rates are materially higher? It certainly changes the economics for a lot of the players at hand, which are already still kind of in question.
Well, it raises the question, too, Julie. I mean, when we talk about the idea of trying to value something that is still relatively unknown, there are a lot of people that would look at some of these forward multiples, even the current multiples on these AI-related stocks here. And then they would try to draw comparisons to some of the last big sort of inflection points that we've had in our economy. There's a big argument to be made. Not sure I buy it, but there's a big argument to be made that some of these stocks are actually cheap relative to the potential that AI might actually bring.
I think that's true. I mean, I think both things can be true, right? We can be in a situation where there is an overbuilding that happens. We've never done any technology transition and not overbuilt the asset base around it. That's never happened. So I expect that will still be the case here today. The question is that there still probably are winners, and they still probably are trading at multiples that are really fair or attractive. So I think it kind of depends. I think the biggest challenge that we have right now is that the underlying economics of who is actually going to generate the outsized returns and economics from AI are still in question, right? I think it's tricky when we're thinking about a lot of how we do AI, how we use tokens, when we know they're being heavily subsidized. It's a lot like, do you remember the first time you took an Uber ride? It felt like magic, right?
Yeah.
It was so cost effective.
It was
and
cheap.
It felt so frictionless.
Yeah.
But it was being paid for by venture capital, right? And now the economics have really changed. Now they're really true. So because we don't really have a lot of insight, it's not clear to me whether truly the beneficiaries of AI will be the large language models. Will they be the software providers? Will they be more like the Palantirs? Right now, the biggest beneficiaries are the chip companies, and I think that's why they're trading the way they are. But what if we're overbuilding? Is that still true in the long term? I don't know.
Riding an Uber is still a joy to me every single day. But Julie, you're seeing investors favor lower quality small cap names over high ROE names. Do you think that's speculation creeping back to the market? How are you reading that?
Yeah, I think it's fascinating. A lot of the companies that are driving the majority of the expansion in small cap, which has outperformed large cap this year, are these lower quality names in industrials often that are exposed to AI CapEx spend. It's not clear to me, though, whether their fundamentals are really deserving of that. Many of them have very low ROEs. They're kind of commodity-type businesses. They're companies very few of us have ever heard of because they're very cyclical and low quality. It's sort of like when, imagine, remember when we all used to dress up and go to a bar when we were underage? We didn't belong there, right? We just did not belong there. And that's a little bit what's happened. They're trading at multiples that they don't typically belong at. And I think that when the fundamentals of those businesses start to deteriorate even a little bit, it could lead to tears.
I want to broaden out a bit because many people say the market isn't the economy. So do you think that the economy can keep growing if lower income consumers keep running under credit card debts while the wealthy consumers, well, I guess, keep on spending? It's the classic K-shaped economy that everyone here is talking about.
Yeah, I think that's exactly right. I think that's a question that I'm asking myself a lot right now, is that it really feels like the way that the stock market is structured is that we're moving away from a dependence on the consumer, high income, low income, what have you, and more towards this CapEx spend that feels so strong because most of it is being driven by free cash flow. I think that's fine and that can support the sustainability of the stock market, but it's creating a much bigger wedge between what the average person is feeling in terms of what they feel in the economy relative to what's happening in the stock market. And I think the wider that gap is, the more people are really upset about that. They don't have a sensation that their future is as strong. And there's a clear movement away from, the benefits of labor towards the benefits of capital. When we have big dispersions like that, it can create a lot of economic unrest that I think is important to keep track of.
Yeah, absolutely here. And that gets into a lot of political issues here that I'm not sure a lot of our political leaders are necessarily ready to respond to. I do want to get your thoughts, though, on how the market might respond to basically more companies coming into this market. And I'm basically talking about these 800-pound gorillas that a lot of people think are going to suck a lot of money out of the room. The Anthropics, the SpaceXs, and OpenAIs, if you will, here. And whether there just is enough appetite not only to absorb those names into the market, but whether absorbing those names into the market comes at the expense of everyone else.
Yes. So I think that that's an important point, because I think when people think about the strength of the stock market, they're like, I don't understand how it's been so resilient. It's been able to overlook pandemics. It's been able to overlook wars. And I think what's central to that is there's just so much liquidity in the system and there's too few assets. Well, I really think that some of the IPOs that are coming to market are going to put some of that more into balance. The problem is that what's coming to market, whether it's SpaceX or Anthropic or OpenAI, is that these companies are coming without any real earnings. And so that changes a little bit the economic dynamics of the indices themselves. And I think that when those companies come under the scrutiny of public markets in terms of understanding what their real underlying profitability is, it changes a little bit the dynamic of whether or not this is AI pixie dust or it really makes economic sense. I think as long as those IPOs do okay, it opens the door for other companies to come to market, which we need. We need a replenishment of all the companies that were taken out in the last private equity rounds. But I worry a little bit that these are the tentpoles, because if people do start to step back and question the profitability of this business, it makes it much harder for smaller other companies to come to market as well.
Well, that's what I'm curious about, though, too. I mean, there's a lot of people that talk about what's going on in AI as the idea that it's a flywheel, kind of similar to what we saw with the internet boom, though a different complexion to it. The idea that you do have a couple of big behemoths now that are kind of leading the charge. But at some point, like I said, one person's CapEx spend, in theory, is somebody else's revenue. I guess we hope that that revenue is going to be a little bit more dispersed over time.
Yeah, we would love to see a broadening in terms of the beneficiaries of this right now. Right now, the most honest and clear beneficiaries are the semiconductor companies, and everyone is spending hand over fist in order to really replenish and have strong demand around that. My concern, though, is that we have to move kind of beyond that. We need to be not just in the actual infrastructure layer, but you would like to see a broadening in terms of having more software participation or seeing other smaller businesses. And I think that's that dynamic that makes it a little bit harder to feel really confident that the underlying economics of all of these businesses are sustainable, right? Like, we don't want a whole bunch of pets.com and Cosmo.com. We want businesses that have good strength and durability to them. And I think there's still the potential for that. But the economics have to be there, and it's not clear that they are.
Julie, around 30 seconds here, you note that this rally feels pretty joyless. Does the fact that it's driven by earnings and not multiple expansion at least make it healthier, if not joyful?
Yes, absolutely. I think that one thing that's given me a lot of confidence is just the level and the breadth of the earnings growth that we're seeing beyond the Magnificent Seven. We're seeing it in small cap and we're seeing it in mid and large. And that kind of strength in earnings for sure is much healthier to have and support, and to support a market than just pure multiple expansion, which is so much of what we felt last year. So to me, it's a much healthier underlying recovery, but what remains to be seen is kind of how durable it can be.
Julie, always a pleasure. Always great to talk to you. Julie Biel, portfolio manager and senior research analyst over at Kayne, Andersen, Rudnick, counting us down precisely to those closing bells that we get here in New York. We should point out that things could have been a lot worse. The S&P 500 did open higher on the day. It was down about 1% at one point. It looks like it's actually going to close the day relatively unchanged, down about 5 to 6 points, or less than 0.1%. Similar story for the NASDAQ. It's going to close lower by about 0.5%, but it had been down well over 1% on the day. The Dow Jones Industrial Average adding about 150 plus points here on the day, going to close higher by about 0.3%, while the Russell 2000, Isabel, lower by about 18 points, or 6 to 0.7%.
And looking at the IMAP now, Romain, it looks pretty mixed. Biggest losers in tech down by 1%, industrials down by 0.5%, consumer discretionary down by 0.2%. The biggest gainers there, consumer staples, not a surprise, up by around 1.5%, and healthcare higher by 0.4%.
And we should point out, too, it's kind of interesting to see exactly the complexion of what we saw in the S&P today, with the vast majority of the names higher. About 360 names actually did finish in the green. Of course, the reason why we're in the red is because that did not include NVIDIA and Micron and Apple and a lot of the more heavy-weighted names. But, of course, that could change in a big way in just about 48 hours when we do get NVIDIA's latest earnings report.
NVIDIA Day, can't wait for that. But it's really a bifurcated market. When you look at AI, everything is rainbow, butterflies, and sunshine. But for the rest, you see a little bit of mixed concerns, from inflation to Iran to oil and all of those other markets. So definitely a split market there.
We saw that with the slight elevation in oil prices today, and we saw that with the continued volatility in the bond market. The moves that we saw in yields, at least to close out the day, don't look like much here. You can take a look at there on your screen with the short end of your curve down less than a basis point on the day, while the longer end of the curve up about 1 basis point on the day. A little bit of a recovery overall from that big sell-off shock that we had on Friday, but a lot of folks predicting that that may just be the start of something bigger as we move deeper into the week and into the month. Joining us right now is Michael Ball, who covers all this for us at Bloomberg News. And Mike, I do want to get your kind of thoughts on this idea of how much the bond market is driving the sentiment in the equity market, because we started off the day and there seemed to be a lot of jitters in equities. But as you can see, as we got closer to the bells, the dip buyers came back in. A lot of people, at least for right now, saying not too worried about inflation, not too worried about yields for now.
Yeah, today was a good sign that rates actually decoupled from oil, because oil was doing about $6, $7 ups and downs and finding a level every time we got a new headline out of Iran and out of Trump himself. So I saw it as a positive that yields were a little changed. But of course, that's after an exhausting week last week where there was a lot of real rates coming into the back end and the curve steepening. So some of that's already priced in as far as this greater inflationary concern. But also the growth impulse has picked up a lot lately, which may explain why we had a better breadth actually in equities today, and we saw value sort of outperform. So it's not really all about this AI secular trade, which is somewhat, overbought, and we know going into NVIDIA, you might want to take some chips off the table.
And you make an interesting point. You said that this is more a rotation rather than a breakdown, and we're seeing the laggards like defensives, values, and others of those kind making the better bid compared to the AI names.
Yeah, again, it's funny because I look at the option market a lot, and when I look at some of the tech names and when I look at where call skew is or how much someone's paying up to get an option exposure to that, we're talking 99 percentiles, like things that we haven't seen 5-10 years. So it's really high up there, and you have to have these results really, really meet and beat. And I guess to hammer home what you guys already know, that's usually not what happens. We've seen it time and time again, going into a lot of these big earning events where people overpay for the upside and they have to kind of scramble. But that's an isolated pocket, and I think what we're seeing now is people trying to get ahead of that and move into better valuation propositions elsewhere in different sectors.
But where is that, though? Because, we talk about a market that's been driven largely by big tech and big AI, but an economy, too. There was all that hay made over that last GDP report where something about a third of our growth was somehow tied to technology spending.
Yeah, again, we're seeing it in two ways that make it very clear. We're seeing a fixed investment pulse that is expanding actually outside of just the AI CapEx. So manufacturing, a lot from the onshoring is doing quite well. We're restocking our inventory, so there's a better pulse there. We've seen a bigger defensive push, and we've also seen the infrastructure push, which obviously aligns with the AI needs, but in itself is its own kind of fixed investment sort of story, and adds a little bit more of a fiscal pulse. But I guess to answer your question too, we know what's happening in the capital goods. We see that in durable goods, and we see it in the pricing through PPI of a lot of these electronics and inputs that we have.
Yeah.
So we are getting a sense this is a tangible, real story, and it's outside the consumer for once, which is why, again, to your point with GDP, final domestic demand is being held up basically by the investment pulse for the first time. Well, not the first time, but for the first time in a long time versus the consumer, which is, 70% of the economy and moving more sideways.
And on Wednesday, it's a big day. It's NVIDIA Day. How are you reading how investors are positioned?
Yeah, so implied vol for the day is around 6% for that name. And that's a pretty high level given how big it is, as far as market cap. What I said earlier, I think, is probably the best way to look at it. There's a lot baked into the results. It has to exceedingly beat. And I'm not so sure anymore, though, if NVIDIA is really going to be the tell-all for the AI trade. I think it's become decoupled. We're not really talking about GPUs anymore. We're talking about boring CPUs and TPUs and optics and all these other things. So again, it's not really the bellwether it used to be, but it is interesting that there's so much implied into the move it's going to get out of this earnings all the same.
Did you actually hear the Jensen Huang, Michael Dell interview that they did earlier? Because, this is exactly the question comes up, and, hey, it all connects, and somehow. Well, he's been a great salesman. I don't mean to make light of what Jensen has done, but there is this idea here as to, have we sort of reached kind of that inflection point where you've pretty much sold, and obviously they'll sell more, but the idea that growth rate that we've seen with regards to the sales of all of those high-end chips, whether that has kind of reached its peak, and maybe we have to start kind of reassessing the valuations on some of those names.
Right, and that's the question. And we talk to the PMs and traders. They're still saying that's a few quarters out, but that's obviously what we're watching. We did get good numbers this quarter, basically saying that the pie is still growing. And as long as the pie is growing, then you can have the multiple expansion, and clearly you have the earnings guidance up revisions. So it's still a very positive AI CapEx story, but that doesn't mean we don't have bouts of froth as we've seen the last couple of weeks, which is displayed in the option markets that need to come off into events. So as soon as NVIDIA passes, the actual implied vol of the whole AI complex comes down. So if you're sitting on options, you're going to lose some value just because of the passage of a risk event.
All right, Mike, great stuff here. Michael Ball, one of our market strategists here at Bloomberg. As we count you down to the closing bells, a market that just closed slightly in the red here on the day. We'll be back in a moment with more coverage, including a closer look at the macro situation and a closer look at that sell-off in the bond market. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostic. Markets did close just about 9 minutes ago with the S&P 500 lower on the day, but as you can see here, you might as well call it unchanged, and it is a big turnaround from where we were just a couple of hours ago in the session, where it looks like we were headed for a down day of about 1% or more. Dip buyers did come back in late into the session, helping to lift the S&P 500, helping to lift the NASDAQ, though both did close in the red. The Philadelphia Semiconductor, of course, one of the bigger drags on the day, largely because of the outsized impact from NVIDIA. You take a look at the 30-year yield there, and that has been a big topic of conversation, particularly with the elevation that we've seen over the past few weeks. That situation that's been going on in the bond market has raised a lot of concerns about some of the long duration bets that we've seen in some of these big tech stocks. Because, of course, if those yields continue to rise, it causes a recalculating here of some of those valuations that we've seen. NVIDIA and some of those long duration stocks, they were not spared today. It reports earnings in the next 48 hours. It's down for a second straight day. Intel, Micron, some of those other names down for a third, fourth, and fifth straight day. So something to keep an eye on as we get deeper into the week. Meanwhile, interesting note out earlier today by Gil Loria over at D.A. Davidson, initiating coverage, or assuming coverage, I should say, of both Salesforce and ServiceNow. He has an underperform on Salesforce, but a buy rating on ServiceNow, and that's a big deal here. A lot of talk about that SaaS apocalypse. He's not quite seeing that, saying that ServiceNow actually might have a little bit of a moat around it as we move deeper into this AI build-out. And that brings us to our top story for the hour, and that is the cost of capital for this CapEx-fueled AI build-out. At the crossroads now of a rise in long-term interest rates that for now, well, it looks anything but transitory, maybe. Altogether, the average 10-year yield across the group of 7 nations has risen to its highest since 2004, and the rate of change has been rattling for some. 10-year Treasury yields, which were at a 16-month low of 3.9% on February 27th, the day before the U.S. began bombing Iran, well, they've surged. Since then, German bonds are up more than 50 basis points. U.S. benchmark yields have surged 66 points, and U.K. gilts have jumped almost 100. Assessments from Bloomberg interviews with 32 investment managers across the globe showed relative bullishness on equities, but still growing concern about stagflation and hawkish central banks and how that could upend the party. For the rest of the hour, we will talk about this from the perspectives of government credit ratings, consumer spending, and at least one theory on how best to protect your portfolio in the event of an economic downturn. But first, we want to get the macro picture. Joining us right now is Darius, the founder and CEO of the research firm 42 Macro. Darius, great to see you here. I wonder if you could maybe put this into perspective here, because there are a lot of conflicting opinions about where we stand right now. You have an economy overall that appears to be holding up, an equity market that, despite the downdraft today, still not far from its record highs, but signals coming out of the bond market that are causing a lot of concern out there. How do you read it?
Oh, thanks again for having me, Romaine. It's always a pleasure. So things are fine from an economic perspective, and you can make the case that they're actually too fine. We have nominal GDP tracking up about 10% on a 3-month annualized basis. And so for this and for a variety of other reasons, we think the Fed is falling behind the curve. When you look at what the market's pricing in for neutral, and we take in a cutting cycle the minimum value on the OIS curve about 5 years, or in a hiking cycle, we take the maximum value on the OIS curve about 5 years, you can see that the minimum value now, the market's estimate of neutral, if we were still in a cutting cycle, which we may not be, is now higher than the effective funds rate. And the effective funds rate is actually two rate hikes below from where it actually needs to be just for the Fed to get back to neutral. So this is a Fed that's falling behind the curve and should actually contribute to bond market volatility in the months ahead as it struggles to catch up.
Well, that's what I'm curious about here. I mean, the whole narrative on Kevin Warsh, who's expected to be sworn in as Fed chair before the week is out, the whole narrative on him was that he was going to be a little bit more dovish when it came to monetary policy. And I know a lot has changed since his name was first floated as a potential Fed chair. But do you get the sense here that he will try to stick by, I guess, that longer-term structural narrative of easier monetary policy, or give in to, I guess, what the economic data might actually be telling him?
I think he's going to wind up giving in to what the data are telling him. And the reason is twofold. One, you're actually getting ever so slight signals from the administration that they're okay with the Federal Reserve actually maintaining some inflation fighting credibility here. You got Besson signaling that, hey, the Fed can wait on cutting interest rates. President Trump was out with similar commentary this past weekend. And then secondarily, if you look at the metrics that Kevin Warsh himself was highlighting, specifically trim mean CPI, we're now tracking up at 3.4% 3-month annualized. That number is higher than the 6-month annualized rate of 3.2%, higher than the year-over-year rate of change of 2.9%. We got a strong positive impulse in the inflation statistic that Kevin Warsh was going to anchor on to lower interest rates. And so, in our opinion, he's going to wind up at an FOMC where most of his colleagues there are going to be moving in a hawkish direction, and they should be, because the bond market is telling them to.
I do want to get your thoughts on something that one of our previous guests, Julie Biel, brought up, and it was the idea of what artificial intelligence might actually mean for the economy, and particularly what the response might have to be by the government. The idea that whatever upsides we're seeing in the market from this with regards to the CapEx spends, it might come, at least in the interim, with some sort of cost to jobs, to American jobs. And the idea as to whether the Fed, or really even fiscal policymakers, have a response, or even can have a response to that should it actually materialize.
Well, they can and they should. I think that's a you and I can grab some beers for this kind of conversation. But the reality is they can and they should. That's why we have a democracy. That's why we elect public officials to answer and solve these big problems for us. But one thing I would highlight, just from the perspective of investors, is the fact that AI, at least in 2026, is a roughly $800 billion positive demand shock for resources and positive demand shock for capital that's expected to grow to about $1.2 trillion next year. So as disinflationary and as productivity enhancing as the technology may be longer term, in the interim, it is actually pushing up demand in the economy and pushing up inflation. And we can see this across a variety of inflation statistics. Every single core inflation measure where you look at PPI, CPI, or PCE is in a strong positive impulse or a weak positive impulse at a level that is significantly higher than the Fed funds 2% target.
So kind of tie this up, though, because we get to this idea of whether we even need a Fed to do anything at this moment. I mean, maybe they need to hike to fight inflation. Maybe they don't. But there's also been a lot of talk of why is there any sort of haste, if you will, to do anything right now, given how well, let's face it, the economy has held up, at least based on the official economic data, and given how well markets have held up, given, the recent record highs that were, just, a few days ago.
Well, that's a great question, Romaine. That's exactly what I said with your colleagues on surveillance a few weeks ago, which is if the Fed does anything this year, they're going to cause problems in asset markets because we clearly have evidence from the bond market itself and from reported inflation data that the Fed is falling behind the curve. So if they ease monetary policy, you're going to exacerbate the meltdown of the bond market. However, if they tighten monetary policy in response to the buildup of inflation pressures, and they're obviously going to cause an unwind of the crowded bullish positioning, and particularly where everyone is concentrated right now, which is in AI. Fun fact, on AI, 48% of the S&P 500 is now tech and communication services, which is higher than it was at the peak of the dot-com bubble.
Is that a risk, though, right now? Because, Darius, someone make the argument that the complexion of this rally is a lot different. The AI bubble was a lot of companies that with no profitability, questionable revenue growth, and this AI boom is being driven by, let's face it, the biggest companies in the world with some of the biggest cash stockpiles in the world who can borrow at relatively low rates.
Well, they still have to meet investor expectations for their sales, their earnings, their cash flows, their return on invested capital, their return on equity. Those expectations are going to go, they're growing exponentially alongside the CapEx. And so ultimately, investors are going to want their money back. And this dovetails actually back to your previous question, which is what are the societal ramifications of this? We've been very much on record for the past few years that AI is going to cause a, kind of low hire, low fire dynamic in the labor market to continue. And in our opinion, we think that's going to accelerate in the coming years in terms of its depressing impact on labor demand. And if that's true, then you start to think about what's going to happen from the perspective of the political response. You're going to be talking about nationwide wealth taxes and redistribution. You're going to be talking about a heavy hand of regulation coming from the other side of the political aisle in response to some of these dynamics. And so at the end of the day, no matter how profitable these companies are and how game-changing this technology is, there is another side of the trade that investors won't be prepared for in terms of how much concentration we're seeing at the current juncture.
All right, Darius, great stuff. Darius Dale, founder, CEO over at the research firm 42 Macro, talking about some of the valuation and economic concerns with regards to the AI build out. Meanwhile, there's a little bit of calculus going on with regards to valuation of Elon Musk. Well, I guess we'll just call it his prime company now, and that is SpaceX. He says he wants to get an IPO underway pretty soon. We're going to discuss with Steve Wesley, the former Tesla board member. That's coming up next here on The Close on Bloomberg. All right, Elon Musk says he's working on plans for SpaceX's IPO as the company gears up for what could be the largest listing of all time. Joining us right now is Steve Wesley, founder and managing partner of the Wesley Group and a former board member over at Tesla. All right, Steve, this is obviously going to capture the attention of everybody, but there are some big questions here about exactly what the complexion of this company is going to look at, like the idea of a roll-up of all of Elon's companies into one or something standalone with regards to his ambitions for space. What are you expecting?
Well, it's certainly ambitious. Look, it's going to be a blockbuster IPO, likely to be the largest ever, eclipsing the record set by Saudi Aramco. But give full credit to Elon Musk, Gwen Shotwell, the entire SpaceX team. They've done everything right. The big question for investors is this a good investment? There's an awful lot to unpack here.
Well, let's unpack it. One thing that's been talked about, the idea is sort of what this actually means for his current publicly traded stock, Tesla, and whether some of the demand for SpaceX will siphon off demand for Tesla's shares.
Look, SpaceX is going to be exciting. Everybody's going to be talking about that. Tesla is clearly going to get a bump. It looks like Musk really has the Midas touch here. But Tesla's revenues have been flat for the last 3 years. So Tesla's got to get back to profitability, show some growth. But aside from that, this SpaceX thing is going to be huge because you're combining rockets, satellites, AI, now possibly a $55 billion semiconductor plant. My God, this is every hot investment sector all at once. You got to be impressed with the boldness of this.
How do you actually, though, value SpaceX heading into this? I mean, I know there's a lot we don't know, at least if you're not already invested in this in the private markets. But we talk about these long-term bets that Elon Musk seems to be taking with regards to SpaceX beyond just the core business of the government contracts. And I do wonder if this is kind of a repeat of what we saw with Tesla, 10, 15 years ago when everybody was like, okay, you're selling, 1,000 cars, where do you take this?
Look, there are definitely going to be a lot of naysayers here, and that's why every analyst is, I think, chomping at the bit to see the numbers when they put the S1 out there. What we do know is SpaceX is clearly the leader, responsible for about 75% of all rockets going into space, U.S. and global. But they're doing $15 billion or so last year in revenues, growing healthily to $24 billion projected this year. But I'm not sure that gets you to a true $2 trillion valuation. The real question is, what everybody's looking to see is what exactly are the numbers of Starlink. But you got two industry leaders with SpaceX on the rocket side, Starlink on the satellite side. And then comes the big question. Everybody's waiting for Anthropic and OpenAI to gear up in the AI space, but now you've got an Elon Musk entrant with Grok and possibly Cursor, which they now have an option to buy for $60 billion. You put all those together and maybe throw in now $55 billion for semiconductors. Mm-hmm. Gee whiz, what's not there? You just got to wait to unpack the numbers.
Do you think, though, that will be folded in before the actual filing so that investors get some sense of it? Or is that maybe sort of a longer term, once we go public, we'll start to work in some of these other assets?
Well, that's the big question. So Cursor's just an option to buy. They'll probably leave that out, but use it to spice things up a little bit. But I think that you're clearly going to see all the numbers for SpaceX, Starlink. You'll see numbers for Grok. And, people are willing to bet the come on these things because OpenAI and Anthropic have been about the hottest companies on the market. Most people can't get into them. This will be one of the first big AI plays you can get into. And who's to say one won't give Sam Altman and AI? I think it's going to be a tough road to hoe, but it's sure going to be attractive to an awful lot of people. You throw in semiconductors, this is going to get a lot of attention.
I am curious, too. I mean, you were on Tesla's board, and, there's been a lot of discussion over the years about the key man risk, the idea that Tesla was so defined by Elon Musk himself, at least in the eyes of investors. And I do wonder, this was 10, 15 years ago when you were there. I'm just curious as to whether investors should be a little bit more concerned with regards to SpaceX, given that Musk is now a lot older. At some point, he may decide he wants to do something else. Are you betting on SpaceX, the company, by buying into this IPO, or on Elon Musk, the man?
Well, look, it's both. $2 trillion. The financials are unlikely to justify that off the bat, but it's tough to bet against his track record. Now, Tesla's had some ups and downs, but SpaceX, again, industry leader. Starlink, industry leader. Who's to say he won't do that again with his internet plays? But, other things like Twitter never quite turned that around. That's barely going to be a factor here. But let's just say he hits on 2 of the 4. My goodness, that could well blow away the $2 trillion valuation, especially if he delivers on the AI side. And I think that's what people are really going to be taking a close look at. Is really enough here that he's going to go toe-to-toe with OpenAI and Anthropic? I think he's got some catching up to do, but gee whiz, just leading with SpaceX and Starlink is going to make this a very attractive IPO.
Steve, we always appreciate your insights. Steve Wesley there. He's the founder and managing partner over at the Wesley Group, and he served on Tesla's board, also as the former controller for the state of California. Now, when we come back, we're going to return to our conversation here about what we've been seeing in debt markets and some of the concerns about the fiscal situation around the globe. Moody's warning that financial markets could reprice further. We're going to discuss with Atsi, Chief Credit Officer over at Moody's, when we come back after the break. This is Bloomberg. All right, amid the recent bond rout that has seen investors demand more compensation to buy government debt, it's worth a look back in history to 1 year ago this week. That was when Moody's downgraded the U.S. government's AAA status. It was a credit rating Moody's had held since 1917. Through 2 world wars, the Great Depression, the Cold War, the 1970s oil shocks, the global financial crisis, and the COVID pandemic. But the resiliency of the U.S. financial situation may now be facing its biggest test. Not necessarily a test from a one-off event, but the cumulative effect of decades of fiscal imprudence that leaves the U.S. more vulnerable, well, to one-off events. That was the argument Standard & Poor's made back in 2011 when, after 70 years, it cut its AAA rating amid a debt ceiling standoff that it said illustrated Congress's incapability in tracking and keeping down the rising U.S. public debt burden. The White House derided that decision, we should point out, arguing that no matter Washington's inability to agree on long-term fiscal plans, the world's largest economy, backed by the exorbitant privilege of the dollar, would never not make good on its debt. But quibble all you want. S&P was onto something. By 2011, Congress was on its way to a 15th straight year of failing to complete its appropriations bills before the start of the new fiscal year. And by 2023, an additional 12 years had lapsed of the same. That prompted Fitch to join S&P in dropping its AAA rating, forecasting that the U.S. debt burden would reach 118% of GDP by 2025, more than 2.5 times higher than the AAA medium at the time. While 118% never materialized, as of March 31st of this year, the U.S. debt to GDP ratio did surpass 100%, with the debt burden on pace to close out the fiscal year higher than the size of the economy itself for the first time since 1946. Now, our next guest leads credit strategy and research over at Moody's, which recently released its global outlook here, saying that financial markets could reprice further if investors conclude that the disruption in energy flows since early March failed to normalize, putting upward pressure on inflation, downward pressure on economic activity at a time when fiscal concerns are already elevated. A scenario the bond markets that we've been talking about all day have already started to price in. Atsi Sheth joins us right now, Chief Credit Officer over at Moody's Rating, to discuss. Atsi, great to see you again.
Likewise.
I don't want to be overly dramatic about this, but there has been a lot of rumblings in the bond market here about sort of pricing up that term premium with the idea here that some of the inflation we've seen and whatever residual effects come out of it is anything but transitory at this point. And I'm curious as to how you're getting a read on what's transpired over the last couple of months.
Absolutely. And I think you're right that on the one hand, the market is repricing the idea that this was a one and done shock that would be over in, a few short weeks. That's number one. But the second, and this goes back to your previous point, this is coming on top of several shocks to the fiscal position. Mm-hmm. The pandemic did leave not just the United States, but a lot of other advanced economy governments with a high debt burden. And on top of that high debt burden, you now have an additional shock. So that's number one. I think there's two things going on with the sort of repricing we've seen since Friday. One is a realization that these kind of geopolitical shocks are not going to help the fiscal position. So the budget deficit, which is already very high, mm-hmm. is likely not going to come down. So that's fiscal. And the second is that the rates outlook now is looking very different than when we entered this year. We entered this year thinking that the central bank, especially in the U.S., would lower rates at the end of this year. That now seems very unlikely with inflation. So I think both those things came into play.
But, people who are bullish, both on the bond market as well as the stock market, they would make an argument here. They would say, look, so far we haven't seen anything too alarming in the economic data. GDP growth is still relatively solid, certainly here in the U.S. You have a stock market not far off record highs. And a sense here that even if we do get some sort of pullback, it won't be kind of the global financial crisis event that maybe some people were worried about.
Oh, I would fully agree that we're not headed into a global financial crisis event. At least none of the data suggests that today. And the second thing I would underscore is that the U.S. economy is indeed a tremendous support to the U.S. fiscal position and hence to the U.S. ability to repay its debt, which is what you were talking about. However, mm-hmm. I do think multiple cumulative shocks are having an impact. And if you began, so for instance, we began the year saying, look, the U.S. grew at around 2% last year. It will probably grow a little bit more this year and then a little bit more next year. We're now saying 2% last year, just a little under 2% this year, and just a little under 2% next year. It's not a big change, but not as positive mm-hmm. as we once were.
I'm curious, though, if for some reason the economic situation globally does deteriorate, how much ammunition do, for that matter, monetary policymakers and fiscal policymakers have to support to support their citizens, support their economies?
I would say they do have a lot of ammunition, and you've heard today China talking about the global situation and its own economic situation turning a little bit more adverse. Now, China certainly has the wherewithal to push stimulus into its economy, and it probably will. The U.S., too, has the wherewithal, fiscal stimulus. For instance, this year, we'll see that tax refunds are probably going to support the consumer because of the tax laws passed last year. Should there be another shock, there could be support that you see to sectors or households to sort of offset the energy shock. And the U.S. can probably take that on its balance sheet without paying a much higher rate of interest. But again, that's this year. When you look out 3 to 5 years, how many more shocks can the fiscal afford before your ability to combat the next shock becomes constrained?
Well, that's what I'm curious about, because we talk about these multiple shocks. I mean, there's all these memes online, particularly from the younger generation, saying I'm going through my, fifth once-in-a-lifetime crisis right now. But it kind of gets to this idea that, is this kind of the new normal where governments are going to have to just deal with what is now basically just economic and geopolitical volatility constantly?
Couldn't agree more. I think those of us, if you began your career sometime after 1991, you've had this remarkable 30-year period when geopolitics were really positive. Whatever sector you were working in, whether it was, technology or manufacturing or trade, the geopolitical situation was positive. Inflation was coming down every year for 30 years. Interest rates were coming down every year for 30 years. That has changed. Part of it is geopolitics. Part of it is other things. The populations are aging. We have another boost to technology coming from AI, but that's a very capital-intensive boost to technology. That's going to cost us in terms of energy as well.
You mentioned sort of this idea of the relative stability ahead. There are a lot of economists that point out that stability was the anomaly, at least over the course of kind of modern human history. And then this volatility we're seeing is probably more indicative, certainly for the U.S. I mean, I think other countries have sort of dealt with this volatility much longer than we have, and maybe now we're just getting a taste of it. I do wonder, though, when we talk about how much the markets and to a certain extent the economy is dependent on that AI build out and the CapEx spending from it, is that vulnerable in your view in any sort of short to medium term nature?
Two sort of areas of vulnerability. One is the energy intensity of it. First of all, that this is going to require a lot of energy at a time that we're in an energy shock. So in the near term, how do you navigate that? Two is the cost of AI. One thing that's very interesting, and it's been pointed out, that the cost of using tokens, people, when we first got generative AI and agentic, people were talking about the gee whiz of it all. Now people are talking about the cost of it. So I do think that's another vulnerability, that if you want something to really explode, it needs to be cost effective. So that's it. Having said that, if those two are navigated, and those are two big ifs, the productivity positive shock to the economy could indeed be tremendous, and that's the offset.
And that's a big deal, because, I mean, we have, at least in this country, there hasn't been much productivity growth, certainly not in my lifetime.
Yeah.
All right, Atsi, always great stuff and really sensible view of the world. Atsi Sheth, Chief Credit Officer over at Moody's Ratings. A quick check here on how we closed on the day with the S&P actually opening higher on the day. It was down about 1%, but managed to close out the day relatively unchanged here. But of course, all eyes, particularly this week, are going to be on the Philadelphia Semiconductor Index, with NVIDIA set to report earnings in less than 48 hours from where we are right now. This is The Close on Bloomberg. All right, we've been talking all day about the global bond sell-off, particularly with bond yields now near multi-year highs as rising energy prices stoke inflation concern. But our next guest says that the energy spike has renewed questions about the strength of the economy and that its bonds might be the place to be during any sort of economic contraction. Christine Benz joins us right now. She's Director of Personal Finance and Retirement Planning for Morningstar. Christine, great to have you here. You wrote something a few days ago that caught my eye, and it was kind of, I guess, what a lot of people forget about amid all the sort of the day-to-day moves and the ructions, and that's the idea of what bonds are supposed to be in your portfolio, or I guess more importantly, what they can be, particularly when times get tough. And you make the case here that if we are indeed headed towards any sort of economic recession or any kind of economic pullback, that bonds might actually be that ballast in your portfolio.
Right, which is not to suggest a recession is imminent, but when we examined performance patterns of the major asset classes during recessionary periods, so during those periods when GDP growth had contracted, what we saw was a consistent pattern of bonds gaining value in those periods. So in 8 of the 8 recessionary periods that we examined, going all the way back to the Depression and then up until the most recent contraction, which was in the spring of 2020, what we saw was that in 8 of those 8 periods, bonds did gain ground. Stocks were less consistent during those periods.
I am curious, though, when we talk about where yields are now, and particularly if you are, and I'm talking less about bond traders, but more importantly, buy and hold type of bond investors. I mean, I'm just looking at the Bloomberg terminal right now. I mean, you're getting 4.5% on a 10-year Treasury, above 5% on a 30-year. Even short-term Treasuries, you're getting, high 3s to low 4s. I would think, particularly given the cycle that we were in for, the previous 15 years, I would assume that would be the kind of thing you would want to lock in to a certain extent, or not?
Well, potentially, and you're absolutely right that those higher yields do kind of put a floor under your potential losses, whereas even 3 or 4 years ago, fixed income investors really had no margin for error because their yields were providing them no cover whatsoever. Going forward, at today's higher yields, fixed income investors are somewhat protected, which is a big change about.
When we talk about sort of this idea of kind of having some sort of safety asset in your portfolio, I would assume that extends beyond just treasuries and sovereign bonds.
It does. So we've been running this diversification study where we've been examining various asset classes in periods of market stress. Cash has consistently looked like a decent holding to have, and of course you wouldn't want to have too much cash given where we are with inflation, but cash has earned its keep as a diversifier alongside equities, alongside fixed income. Gold also looks somewhat decent. So during these recessionary environments that we examined, gold earned positive returns in 6 of those 8 recessionary periods. In the 2 of the 8 recessionary periods where it wasn't as good, the losses were quite modest. So while gold is not shouldn't be, I don't think, a large part of most investors' portfolios, it does appear to be a decent holding in recessionary periods.
You've also made the case for greater international diversification for U.S. investors. And I know we've seen some degree of a rotation, certainly amongst the institutional side, over the last few months here. How far do you structure your portfolio around non-U.S. assets?
Well, it depends on the investor, but I do think that for younger investors, and here I would say that would be like people under 50, should think about kind of following the global market cap in terms of setting their non-U.S. allocations. So it's probably 30% of the global market would be non-U.S. stocks today, maybe a little bit more. I think that's a good benchmark. For older investors, people who are in drawdown mode, retirees, for example, they might want to pull back a little bit from that weighting, but the valuations, the higher dividend yields in non-U.S. stocks still seem like strong selling points today.
When we talk about sort of the longer-term structural shifts in the economy, whether it's what's been driving us with regards to AI, also maybe potential shifts in geopolitical power here, does that change sort of the, some of the longer-term thesis we've seen with regards to retirement planning and where you put your money, or is it sort of too soon to make any sort of wholesale adjustments to that?
Probably too soon, but I do think, Romaine, that one phenomenon I've seen is that many older adults, people who are in drawdown mode, have had such a great experience with equities over a very long time period. They're quite reluctant to add anything to safer assets. Fixed income hasn't made a great case for itself over the past couple of decades. But as you say, with those higher yields today, locking some of that stable income in really looks like a good call for retirees. That balance, I think, makes a ton of sense for people who are actively drawing upon their portfolios, because the thing you need to guard against is that big equity shock occurring early in your retirement. And if you're all equities, you'll have no choice but to take your cash flows from dwindling stocks, and that's rarely something that you'd want to do.
All right, Christine, really appreciate it. Christine Benz, Director of Personal Finance and Retirement Planning over at Morningstar. We do have some breaking news here out of Elon Musk saying that he will appeal that OpenAI trial verdict with the Ninth Circuit. Remember, we reported earlier today that a jury had rejected Elon Musk's claim that OpenAI's Sam Altman betrayed its mission to benefit the public by morphing into a for-profit business. Elon Musk now speaking, saying that, quote, the judge never ruled on the merits of the case. These are his words, and that the judge and jury did not rule on the merits of the case, and saying that he will be filing an appeal with the Ninth Circuit, saying that OpenAI, in his words, was founded to benefit humanity. Again, posting these statements on his social media platform X. He also says that in his view, Altman enriched himself by stealing a charity. Remember, the main crux of this case was about the nonprofit structure of OpenAI when it was first founded, and it's morphing into a for-profit business as it seeks a pathway to an initial public offering. All right, we'll be back in a moment, setting you up for what to watch over the next 24 hours, and that includes some earnings, not out of NVIDIA, but out of the retail set. That's coming up next here on The Close. All right, we're at the stage of the earnings calendar where we start to hear from some of the major retailers. Home Depot kicks us off tomorrow, offering a fresh read on the state of the consumer. We get Target, TJX, and Walmart also coming later in the week. Joining us right now is Wendy Liebmann. She's the CEO and chief shopper at WSL Strategic Retail, joining us now as to what to expect. And before we get to some of those individual names, Wendy, I do just kind of want to highlight the environment that we're in here. We've seen consumer sentiment measures at record lows in some cases. We have elevated gasoline prices. And I know your How America Shop research has been tracking kind of how consumers are thinking and, more importantly, how they're spending. And I'm wondering if you've seen any evidence of any material shift in what's been going on with them over the last few weeks.
No, Romain, not really at all. I mean, people are feeling very nervous, very uncertain. So they do what they always do. When things are chaotic, they just take control where they can and they cut back. But they've got things like gas prices and you've got to get to work. So that's a challenge. You still got to get in the car and fill the tank up. You got to feed the kids. You've got to get them, out of school and into summer vacation or something. So there's a lot of pressure and people are being very cautious about how they're spending and where they're spending at the moment.
Well, let's take Home Depot, because a lot of people kind of view this as a bit of a barometer for the economy and to a certain extent the housing market here. I mean, what are your general expectations? Because I assume a lot of what goes on at Home Depot to a certain extent is discretionary.
Yeah, well, that's the benefit Home Depot has is they've got two audiences. So, and if I can't move house and I've got to stay in the place I am and I've got to make it easier, more comfortable, fit another bed for another kid, whatever it is, I got to work that out. And so I can go in there and sort of DIY. So there's that part of it. They've also got the professional community who continue to be the ones try and get a plumber, try and get a builder. Very hard to do these days, even an electrician. So they've got that community who they're really working hard to keep in Home Depot with lots of improved services and loyalty programs, things like that. But you're absolutely right. It is the macroeconomic trends when people can't afford to change their kitchen or do anything like that, build a new deck. That becomes a problem for them, even though they're doing a lot of things to provide the right benefits for the customers who come in the stores.
Yeah, and we should point out not to shortchange Lowe's. They also report as well. Mm-hmm. I do want to get your thoughts, though, on the other retailers, and particularly when we talk about the K-shaped economy and maybe some of the struggles certain consumers are seeing. We've seen a certain benefit driven to, just say, discounters, for lack of a better phrase. Mm-hmm. So that includes a TJX or a Walmart, which, of course, is kind of the behemoth in that space, both set to report this week here. Does that sort of become the tailwind for them?
It does. I mean, in general terms, and you've seen that Walmart's mentioned this before, the pickup of people with higher incomes, 100,000 K household incomes who have now found their way to Walmart. I have to tell you, walk into an Aldi or drive into an Aldi parking lot and the brands of cars there these days are much higher level than they used to be. So even higher income shoppers are really moving into more of those discount places to just be smart about their money, take the pressure off themselves.
Are you seeing, we talk about the consumer spending, Wendy, but I'm just curious about where that money is coming from. Is that cash, or are they relying a little bit more on borrowing on credit cards?
Oh, credit cards. I mean, if you look at some of the increase in the amounts on credit cards these days, they have gone up, and people are having to use credit cards more, particularly middle to lower income households, if they've got a credit card, to use them to go shopping because they just cannot stretch from week to week, month to month, particularly with gas prices the way they are. That's a barometer of that's coming out of the wallet every week when they have to fill up the car to go to work or to take the kids to school or whatever they have to do.
All right, Wendy, I have to leave it there. Always great conversation. Wendy Liebmann, CEO, Chief Shopper over at WSL Strategic Retail. As we move ahead here to what to watch for the next 24 hours, that includes those earnings out of Home Depot, Amerisports, as well as Kava, which could actually be interesting read on the consumer as well. We're going to get pending home sales at 10 a.m. Eastern time as we continue our economic coverage. And then keep an eye on what's been going on in the tech space. The Google I/O Developer Conference begins out there in California. We'll have full coverage from that. And in the political space, some key primary elections: Alabama, Georgia, Idaho, Oregon, Pennsylvania, and Kentucky, all states here that could have a massive impact on the shape and complexion of the U.S. Congress. Also keep an eye on what's going on overseas as Russian President Vladimir Putin starts his visit with Xi Jinping. That does it for us here on The Close, right here on Bloomberg.